You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 6th of May 2025. I'm joined today by my co-host John McEwen, and in this week's episode we'll discuss Associated British Foods, BP, Entain, Whitbread, Haleon, and our US company of the week is PayPal. John, do you want to start us off with Associated British Foods, a favourite of the show?
Yes, absolutely. So ABF, it's the owner of Primark with its 451 stores worldwide, AB Sugar, AB Ingredients, it's got an agri-foods division, and it's got consumer brands like Twinings Tea, Ovaltine, Patax, Kingsmill Breads, and Jordan Cereal, amongst others. They had their half-year results out, with first half revenue remaining flat at £9.5 billion, ignoring exchange rate impacts. Primark sales were up 1%, with overseas growth offsetting a soft performance in the UK and Ireland. Underlying operating profit fell by 10% to £835 million, which was below market expectations. The disappointment was largely driven by a sharp drop in profitability, with the larger sugar division hit by persistently low prices across Europe. Free cash flow fell from £468 million to £27 million, and net debt, including lease liabilities, rose from £2.5 billion to £2.8 billion. Primark's full-year guidance has been reiterated, with revenue expected to grow at low single-digit rates. The sugar division is now expected to post an underlying operating loss of up to £40 million this year. Consensus had been previously £58 million profit. An interim dividend of 20.7 pence per share was announced, in line with last year, and £422 million of share buybacks have been completed year to date. The shares were down around 8.5% in early trading. In terms of valuation, ABF has a market cap of £14.5 billion and trades at 11.4 times forward earnings, compared with a 10-year average of 17.8, with a prospective dividend yield of 3.2%. Overall, I thought these results were disappointing, though largely down to the commodity price shift with the sugar business, which there isn't a huge amount ABF can do about that. That being said, it is a diversified business, and there have been geopolitical issues that have worked against ABF. And I think if you look at the core with Primark, that's a high-quality business, largely saturated in the UK, and I know it had softer trading this time, but it is making encouraging progress in the US. And I think actually, compared with its 10-year average, it's looking fairly attractive from a valuation perspective, and it's not too bad with a dividend at 3.2% either. So I have liked ABF historically, and I do wonder whether it's a time that I might actually go ahead and buy some at the current valuation. Sam, what are your thoughts on Primark? ABF at the moment?
I'm going to have a look at the share price, but yeah, it's always traded historically quite low, I think, in terms of the quality of the business. But 11 seems very reasonable. It's £20 a share. So it's actually trading at a current PE of 10, but that obviously isn't factoring in the issues with the sugar. So it's saying as well, the US sales grew by 17%.
Yeah, it's impressive.
I think the UK and Ireland sales are a bit disappointing, but it's been such a well-run business for so long that for me, they just get a bit of a pass on it. With the best will in the world, you are going to have the odd half like this, and the fact that the US is offsetting it, that's got the potential to be the bigger market, obviously, anyway. Sugar, not really too bothered about. There's nothing they can do about that. So obviously, like you said, sugar prices are down, but then it said as well that there's losses in the bioethanol business, which also has prices down. I suspect the two move pretty closely, given that it's made by the sugar, but I like it. And I think as well, at the moment, when you look at the FTSE at an all-time high, if I look at my own portfolio, there's a lot of stocks that are at very nice valuations compared to what they've been historically. I can't imagine there's as many high-quality stocks on the FTSE 100 trading at such a low valuation with that US potential as well. I think it's attractive in any case, but in the current market for a lot of FTSE shares, I think it's even more attractive. So I do agree with you. I mean, I am inclined to take a position myself potentially as well.
Okay, very good. We'll see if it's the only company this week that you're prepared to take a position in. How's BP doing?
So, BP are not doing fantastically. They have come out with their first quarter results, and sales fell from $48.9 billion to $46.9 billion. Underlying net profit more than halved from 2.7 to 1.4 billion, mainly driven by the gas and low carbon business. Performance was impacted by weak gas marketing and trading and major project startup costs. There was a free cash outflow of 800 million, down from an inflow of 1.3 billion, with reduced operating cash flow more than offsetting a reduction in capital expenditure. Net debt was up by 3 billion to 27 billion. Quarterly dividend rose from 7.27 cents per share to 8 cents, alongside a new buyback of 750 million, compared to 1.8 billion in the quarter just posted. Guidance was largely unchanged, with production expected to be slightly lower than last year. So currently net debt has gone up, as mentioned, 3 billion to 27 billion. They do have a 2-year target of bringing the net borrowings down below 18 billion, but I think they can probably throw that out the window at this point. I struggle to see it unless they start selling off divisions or something. I don't see how else they'd get there. They have made some progress on recent discoveries and new projects as they have been refocusing. It's been covered in the news quite a lot, but I think they have been moving a bit more away from net zero. So they are starting to take a more selective approach, which is likely to focus on areas like hydrogen and carbon capture, which are a bit more complementary to what they're currently doing. In terms of the valuation, the business trades at a forward P of 9.1, and that compares to a 10-year average of 11.7. The prospective yield for the next 12 months is 6.8, and that compares to a 10-year average of 6. I would start to question, if the business continues as it is, how sustainable that dividend is. Do you know off the top of your head, John? Sorry to put you on the spot, but
yeah,
obviously Shell cut their dividend in COVID, and then I think when they brought it back, it was at a much reduced level. Do you know if BP did the same?
I believe they did.
Right, okay.
So I think Shell had been the longest dividend increasing stock on the FTSE. I'm pretty sure. I'll just check.
Oh, cheers.
Yeah, August 2020. Following
okay.
second quarter results for that year, which was obviously the year of COVID.
It just looks a lot unhealthier. I know it's not been as great an oil market as we used to seeing. So, the Shell results are also not as good as we've seen the last few years. But even still, it just looks a lot unhealthier than Shell does whenever we've looked at that, I think. It has also been in the news because Shell is supposedly looking to acquire BP. I don't know how that's going to go, because I think it is just speculation at this point. I don't think there's been an offer. But in the last 5 years, Shell's share price is up over 90%, whereas BP's dropped 30% in the past 12 months. And BP is now sitting only 11% above the share price when they launched the net zero strategy. And this compares to Shell, who've maintained a more balanced approach to the energy transition, and Shell continued to invest in oil and gas while gradually building the renewables portfolio. BP's pivot to net zero did involve aggressive cuts to oil and gas output and heavy investment in renewables, which have not delivered expected returns, which is what has led to the strategy being reversed, although that has also come from activist investors. And so Shell are apparently working with advisors to assess the feasibility of acquiring BP. I struggle to see that going through competition authorities unless they did it with a view that it would allow them to really compete with some of the US oil companies, because the combined company would have a market cap of $320 billion, which would be higher than ExxonMobil, which is partly why I struggle to see it. It would make it by far the biggest stock on the FTSE. I really struggle to see this, but you never know. In terms of valuation, I can't say I find the valuation hugely attractive, because I just kind of think, well, why wouldn't you buy Shell instead? It seems to be better run. You might end up with the same company in any case as it stands, but of the two, I'd definitely prefer Shell, I think. What about you, John?
Yeah, I suppose if you were buying BP as a bit of a turnaround stock, and with Elliott managers taking position in it, whether it is acquired, maybe that's more of the appeal for BP. And as you said, it doesn't seem to have been particularly well run over the last few years, and its tilt towards net zero doesn't look like it's worked very well for the group, and now they're beginning to sort of reel that back in. I would choose Shell. I did used to own Shell. It's very interesting if there were to be a takeover, because I think one of the arguments would be that you'd be able to compete with the American super majors. And at the moment, not that Shell is a small company, but it's not as big as Exxon. Whereas if you had Shell and BP together, then you're up at that sort of size. So don't know, very, very difficult. I wouldn't be buying shares in BP though.
Should we move on to another company that we wouldn't be buying shares in?
Yes, so Entain, we've covered it a few times on the show. I think it's actually been a little while since the last time we covered it. It's a gaming company, and it's the owner of Coral, Ladbrokes, and joint owner of BetMGM. Anyway, they had their Q1 trading statement out, with the group reporting an 8% rise in net gaming revenue when ignoring currency moves and the US joint venture. Performance was driven by a 10% rise in net gaming revenue, with a smaller 2% rise from the retail channel. The US joint venture, BetMGM, saw a 34% rise in net gaming revenue and recorded positive cash profit EBITDA of $22 million. Guidance was reiterated, pointing to a mid-single-digit net gaming revenue growth and cash profit of around £1.1 billion, which is flat year on year. BetMGM is expected to generate positive cash profit for the full year. Stella David has been confirmed as the permanent CEO, and the shares were up around 3% on the statement. In terms of valuation, Entain had a market cap of £4.4 billion and trades at 12.4 times forward earnings, compared with a 10-year average of 14.9, and it currently yields 3.2%. I thought this was a strong performance. Even when you exclude BetMGM, it's a strong performance. It's not an industry I'd ever invest in, more for the ethical side of it, but it's got a strong group of brands in that sector. And with the MGM business and the, I suppose, US business in that sense, perhaps that's the most attractive thing about Entain and what differentiates it from its other UK-listed competitors, and whether it's that US business that's going to drive the growth forward. We have spoken about BetMGM in the past, and I think perhaps when the shares were a little bit more toppy, that was sort of all baked in, but it is continuing to deliver, and I think you're seeing it now becoming profitable, which for a number of years, they'd hoped to get to that stage. And I think we're now here, and it's not an expensive stock at just under 12.5 times forward earnings, and it's still got a relatively decent dividend yield too. So I think it looks like the pick of the bunch in that sector. I suppose one thing always on the bearish side with the gaming companies is always regulation, and that can obviously be a big threat to the industry as a whole. But yeah, as I say, not one that as a sector that I would invest in, but interesting to see how Entain goes in the US. Sam, what are your thoughts on Entain and these results?
Pretty similar. I appreciate it's profitable, but it's still got a way to go, obviously, before the profits get anywhere near the rest of the business. That being said, you'd have to start somewhere, and I think it is the first time we've seen a positive cash profit. So yeah, I'm sure there's a lot more to come, especially if it's continuing to grow at 30% a year. I agree, on a forward PE it looks cheap, considering just how much revenue it could get from that BetMGM joint venture. Very similarly, I also wouldn't buy it for ethical reasons. I know I own a tobacco business, but there's just something about gambling that I don't particularly like. I can understand why someone might call me hypocritical there, and I can also understand why somebody who wasn't bothered and didn't have those ethical concerns would be very interested in looking at Entain, because I think, ethical issues aside, it looks very, very attractive.
Very good. Shall we move on to Whitbread then?
Yes, this is a company that I wouldn't quite say favourite of the show, but it's definitely improved in our estimations the longer we've covered it. I think that's fair to say.
I mean, I think when we started the podcast, it was in the midst of COVID. So Whitbread, with, as I'm sure you're going to come on to, its Premier Inn being the core part of its business, it was sort of decimated at that point. So we did start at a very low point with Whitbread.
We did, but I think had we started in a more normal year, I still think we would have took an initial dislike to it until we got to know the business a bit better.
Fair enough.
Or I would anyway. Maybe you're less judgmental than me.
Well, I think it was at a slight disadvantage, to put it mildly.
So, Whitbread, who are the owner of Premier Inn. They have come out with their full year results, and annual revenue fell 1% to 2.9 billion, driven by declines in the UK. Biggest fall was food and beverages, which was impacted by restaurant closures and disposals. UK accommodation sales were flat, with a decline in occupancy offset by room openings. Underlying profit before tax fell 14% to 483 million compared to analyst forecasts of 472 million. Free cash flow fell from 398 to 295 million, and net debt rose by 7% to 4.7 billion when including lease liabilities. Final dividend of 60.6p meant the total for the year was unchanged at 97p per share. Whitbread launched a share buyback of 250 million to complete over 12 months. UK accommodation sales fell 1% in the first 7 weeks of this year, and for the year ahead, UK cost inflation is expected to be around 2%, and net capital expenditure guidance stands at 400 to 500 million. Germany is expected to deliver its first underlying pre-tax profit of up to 10 million, and the shares rose 4.6% in early trading. So there has been a shift in focus towards integrated restaurants within the hotels, and over a quarter of the 12,000 or so room openings planned by 2030 are actually expected to come from the restaurant conversions. So I suppose that's good if they're still using the buildings. So I just wanted to go into the German side a bit more. Accommodation sales in the German part of the business grew 37% year over year. And the cohort of 17 more established German hotels delivered an aggregate site-level profit of 16 million in the year, which was up from 9 million the year before, which demonstrates the maturing profitability of the estate. Food and beverage revenue in Germany increased by 19% to 26.7 million. As mentioned on previous episodes when we've covered it, the German hotel market is highly fragmented, with around 60% of rooms operated by independent private hotels compared to the UK, where branded chains like Premier Inn have a much larger market share. So essentially in the UK, where you've got like the Premier Inns and the travel lodges that are just kind of dominating the hotel market and much fewer independent hotels, they don't really have that as much in Germany. So this means that no single brand dominates the market in Germany, unlike the UK, which is far more consolidated. So there is a significant opportunity probably for someone to go into Germany and do what Whitbread are trying to do. In terms of Germany as well, they currently have 62 hotels open, and that's 10,965 rooms, and they've got 7,265 more in the pipeline, so basically a 70% increase. And the long-term ambition is actually to almost double the number of rooms to 20,000, which would generate 70 million, or they're hoping would generate 70 million of adjusted pre-tax profit from the German business by 2030. Pre-tax profit this year was 483 million for the whole business, which was down 14%. So it would add, if you say, call it 500 million normalized, making up a number, it would be a 14% increase. I actually think when you kind of look at everything we've seen about the German market, there might even be a chance to get those figures even higher in the much longer term. I don't think this is a hit 20,000 rooms job and then it's job done, because I think at that point there's probably still a lot more market for them to take potentially. So I think it is quite exciting. In terms of the valuation, the business trades at a price to book ratio of 1.26, and that compares to a forward price to book of 1.88. The prospective yield is 3.9%, and that compares to a 10-year average of 2.2%. And the PE ratio is 14. I should mention as well, they've actually launched a £250 million share buyback, which that would probably be my, I say only complaint. The UK side's not great, but I think that's kind of offset by excitement for the German side. But I'd probably rather see that buyback money being applied back into Germany. But yeah, I think these results are slightly disappointing, but there's enough optimism in the German side that I'd still, if I was a shareholder, I'd still be pretty excited about the business longer term. That being said, I can't see myself ever buying shares just because of how capital intensive the business is. It's just not a kind of business model that I'm that attracted to. But I do think they have the opportunity to go into Germany and make a lot of money. And I think it is a very well-run business, and one that I was initially took a bit of a while to understand it, I'd say. What about you, John?
Yeah, no, again, it's been a slow burner for me too. I think the more we've covered it, the more we've sort of begun to appreciate the appeal and the lack of, I suppose, consolidation and saturation in the German market. And it looks like so far that's going very well for Whitbread. So I think there's actually quite a bit more growth ahead of it, and more than I'd ever have expected, in the sense that I think when we first started covering it, it seemed to have sold off everything else almost in the Whitbread portfolio, including Costa, and then have been left with the least attractive business out of all of them. And a business that was very saturated and was having a very difficult time during COVID. But now looking at it, I think it looks good. I would probably not be buying shares, as you say, because it is a capital intensive business, and there are others out there, the opportunity cost argument with it. But still, I think you could do a lot worse than it, and it's certainly an interesting one for us to cover, even if we're standing on the sidelines.
I think for me, although it's not a business I ever see myself owning, I struggle to see them doing better than they're doing. In terms of if I was a shareholder, I'd probably be very, very happy with management. I think the move to Germany was very smart. It seems to be paying off. I think the long-term targets are reasonable, and I think they can actually go and grow beyond that once they've hit them.
Yeah, and I would say as well with the integrated restaurants, again, I think that's great. I think that's where you want them, because I don't see these days many people sort of setting out to go to like a Harvester, etc. I think it's more if you're staying at a Premier Inn, then you may be travelling and you just want somewhere to go in the evening. And therefore, if it's downstairs within the building, that's much more logical. And obviously it makes use of the building too.
And it arguably makes you slightly more likely to go because you kind of have to walk past it. Whereas sometimes when they're to the side or a separate building, it is easier to just kind of forget. Yeah. Not forget, but do you know what I mean? You go in and you think, well, actually, let's go out and find somewhere to eat.
Yeah, no, absolutely.
I think it's more front of mind, actually. So I think it makes sense for a lot of reasons.
Yeah. Okay.
Right.
On to Haleon then.
Yes. How are Haleon doing?
So I'll just give a little bit of background, although I know we have covered it a few times on the show before. So Haleon, it's the group or the consumer health division that was spun out of Glaxo a few years back. And it owns brands like Sensodyne toothpaste, Panadol, Otrivin nasal spray, Centrum multivitamins, Advil, Voltarol, Nexium, and a number of others. They had a Q1 trading statement out with medium-term underlying operating profit growth guidance being nudged up to high single digits starting from 2026, whilst the 4 to 6% annual organic revenue growth target remains unchanged. Improved profit outlook is supported by an expected £800 million of productivity savings spread evenly over a 5-year period. Capital expenditure is expected to be around 4% of revenue on average over the next 3 to 5 years. And there were no changes to the guidance for 2025, with organic revenue growth of between 4 and 6% expected, with higher growth expected in organic operating profit. And the shares were up 4% on the news. In terms of valuation, Haleon has a market cap of £36 billion and trades at 20 times forward earnings with a prospective dividend yield of 1.8%. I thought the news from the business was good and decent statement overall, encouraging with that stronger outlook, and also net debt continuing to fall toward 2.5 times. I don't know if I would ever buy shares in Haleon. I think there's probably a price that I would, because they are sort of decent. It's a decent defensive company with some good brands in there. I think what I struggle with is probably the current valuation with some really good consumer goods companies, and I always come back to Unilever, but like Unilever, with better brands, and particularly with Unilever's new CEO in place, Fernando Fernandez, there are other consumer goods companies that I would much rather buy. And also, even if you looked towards Nestle, the results have come off a little bit more recently, but they arguably have the best brands. So I don't think Haleon would be one for me. But certainly, as we've covered it, it seems to be continuing to perform well, and things are only improving for the group. Again, and we say it quite a few times when we have covered Haleon in the past, Unilever offered $50 billion when the group was in a much less healthy state when it was being spun out of Glaxo, and obviously delighted that they didn't buy it. But I think that gives you some context with the current valuation. Sam, what are your thoughts on Haleon and this statement from the company?
Pretty similar. I think they've done really well since they've been spun out. They've done better than I expected. I would be interested to go and have a look at the results once they've actually been released, because I think the main point of interest for me is the debt. So they were spun out with a lot of debt. They've done a very good job starting to chip away at that. And it would just be interesting to see if that has continued. I've not seen anything to suggest that it wouldn't have done, but for me, that's probably the key thing that I look for with it at the moment. It's not a business I could see myself buying because I just think there's more attractive companies out there. I'm not hugely interested in consumer goods anyway, but if I was, I'd probably be looking at something like Unilever instead. But they've done better than I thought they would, and this seems to be a continuation of that.
Very good. On to a company that you actually own, PayPal.
Yes, PayPal. So they have come out with Q1 results, and they reported a 2% rise in Q1 revenue, which ignores currency movements, to $7.8 billion. Transaction volumes grew 4%, with the peer-to-peer and other consumer segments experiencing the strongest uplift, though that was softer than the 7% growth in the prior quarter. Underlying operating profit was up 16% to $1.6 billion, helped by the business mix, which saw transaction margin rise 7%, as well as good control of non-transaction related expenses. Underlying free cash flow fell by 26% to $1.4 billion, reflecting lower conversion of operating profit into cash. Net cash totaled $3.2 billion, and the company repurchased $1.5 billion of shares in the quarter. PayPal reported a good start to the second quarter, but leaves full-year guidance unchanged due to global macro uncertainty, with transaction margin expected to grow 4 to 5%. I would interpret that as being they're actually slightly ahead of that 4 to 5%, but they don't want to increase it because they've got no idea what's going on. Neither does anyone else at the moment. And worth mentioning as well that since the, new CEO, he's been in a couple of years now, but since the latest CEO came in a couple of years ago, the focus has shifted more from kind of unbranded volume to actual profitability. In terms of the valuation, business trades at a forward PE of 12.5, and that compares to a 10-year average of 27.6. I do find the earnings not as useful for PayPal because what it does do is it churns out free cash flow. So if you value it on a price to free cash flow, it actually trades at 11, and it's on a forecast price to free cash flow of 10. It doesn't pay a dividend, but it is aggressively buying back shares. So it's currently a buyback yield annually between 8.5% and 10%, which is very, very high. On a market cap of about $65 billion, actually. They've got about $20 billion authorised. So it's getting on for a third of the market cap. In the CEO's comments, he highlighted that this was the 5th consecutive quarter of profitable growth, with non-GAAP earnings per share up 23% year over year and transaction margin dollars growing 8%. Total payment volume was up 3%. Active accounts were up 2%. Yeah, I think the transactions per active account growing 4% is very encouraging as well. So I think this is a very good quarter. I think given how cheaply the stock is priced, you would expect the performance to be a lot worse than that. I think these results are pretty good. And as well, you are getting huge yields in terms of those buybacks because pretty much all the free cash flow is just being used to buy back shares. At this price, I'm not sure what else people would expect from PayPal, but at a forward price to free cash flow of 10 with probably 8 to 10% buyback yields per year, I'm very, very happy to continue holding. John, as someone who's a bit less biased, what do you think of the results and the valuation?
I'm beginning to accept your, value argument for PayPal a bit more. I suppose my underlying concern with PayPal is that you've got Apple Pay and you've got Google Pay as well, and that more and more people shifting to that. Now, I appreciate that that's not necessarily being borne out in the results in terms of transaction volumes and active customers, but anecdotally, I suppose that's what I feel. And from my own sort of biases, my own experience, particularly with Boohoo, I think on a valuation perspective, certainly when I took my original stake in Boohoo, I thought it looked cheap. But that was because the wider market was changing around it, and you had Temu and Shein coming in, and purely from a valuation point of view, I thought, well, yes, it looks very cheap. not how much lower can it go. And of course, you have the argument, catching a falling knife. I guess that's what's made me a bit more apprehensive about PayPal. And I think about, when I used to use PayPal myself a lot more, and then increasingly I'm more on the Apple system. So Apple Pay popping up on my laptop, popping up on my phone. 95% of transactions going through that. So I think that probably undermines, for me, the investment case that you make, although it's the value that you're really arguing for with it. And it's difficult to argue with that. Out of interest, Sam, what price did you get in PayPal at?
I will just check now, because I think I've bought it on more than one occasion. I don't think I'm doing amazingly, though. That's my instinct. Yeah, I'm down 2.64%.
Okay,
so I'm basically around breakeven. Yeah. It was doing a lot better, but it's pulled back kind of with everything else. So it was at around $90 before the orange swan, and then it's kind of come back down to where it was. It's like a lot of US stocks. Yeah. It's been dragged down, but the results haven't gotten any worse or anything. It's not.
No.
I don't think that drop is reflective of how the business has been performing. So I'm quite happy to continue holding it. I'm not going to add to it because I think I've already bought it a few times. And although I am happy with the performance, it's still a pretty decent sized position. It was a more decent sized position 6 months ago, but it's still a decent position. So I'm quite happy to just leave it. I think the transaction volume could start declining 3 or 4% a year. And I think you can still make a solid argument for it. So when it's actually growing slightly, I think what the market's probably pricing in, and I think what we have seen with not PayPal, but with businesses like this, is that with these kind of tech businesses, if they start to lose market share, they can lose it very, very quickly. So, and tobacco, because it is effectively a tobacco valuation, but they do not have the pricing power a tobacco business does if they start seeing 5, 6, 7% volume drop-offs. But
yeah,
I think you'd have to get quite high before it actually started to be a concern.
Yeah, no, fair enough. But that probably accounts for why we haven't seen the share price significantly improve. I appreciate there's been the orange swan and things, but yeah.
No, yeah, but my ownership proportion has gone up in that time, though. So.
Okay. Of the companies this week, then, what would come top for you and what would be last?
So they're both quite easy for me. Top is actually, I think, ABF.
Yeah.
I do like PayPal.
Yeah.
Obviously, because I own it, but I think probably I do find PayPal's more, as explained, on the valuation, whereas I do find ABF more exciting. And I think if you're talking about a longer term hold, I could see myself owning ABF for a lot longer than PayPal. Last, it would be Entain for ethical reasons. That's quite easy. If I excluded that, it would probably, it would still be easy. It would be BP. What about you?
Yeah, I mean, easy for me. ABF, definitely first choice. And then if I excluded Entain, it would also be BP. So agreed on that. Okay.
Right.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.